Morning, folks. If you guys can give me an audio check on X, I'd appreciate it while I wait to see what the actual delay time is. I can hear myself, so you should be able to hear me. All right, so it is February 10th. I said we would be back at the home here. And I mentioned before that I would give you some things this year to kind of like simplify it, remove all the ambiguity, all the things that make people, that are a little less motivated to stick with it or really apply a sincere approach or effort behind it. I'm going to remove all the mysticism today. Okay. I've said these things in long abbreviations of rants, technical discussions, the very wordy, lengthy portions that most people don't like to have to endure. But I kind of like want to take it into the chart, show you what it is that you start with. Okay. I don't care where you're at in trading, what your development level is, what your current aptitude is. If it's zero, that's preferred. But if you've been struggling with any measure of knowing what the market's likely to do, where it's going to go, bias, session bias, draw on liquidity, how to get in, when to get in, where to place a stop loss, where to get out at, I'm going to cover all that today inside of 45 minutes. I know, I know it sounds impossible, but I'm going to do it simply because I got a lot of positive feedback from the folks that are watching the channel, and I've tested the AI language generation, and unfortunately, there's a limitation on anything over an hour. It won't translate. So, in other words, you'll be able to hear me talk in Cantonese, Spanish, um, German, Irish, whatever. I don't know about Irish, but the all the languages that YouTube makes available. Now I toggle all of them. Some of them I've seen fail, and I don't know how to overcome that. So like I said, it's a work in progress. It may be something I've done, and I don't know yet how to fix it, but I'm actively working on it. So that way, all of you have ability to learn from me for free right here on the YouTube channel. You don't need to be buying anything. All right. So without all that extra stuff, now that we got it out of the way, this morning I posted on X. And by the way, it's a good morning. I hope you had a good weekend. Hope you had a nice, pleasant Monday. I'm a grandfather now, so you're probably going to hear a different tone because now I feel a little bit more accountable because I have a little guy that's going to grow up, and it's a little bit different having adult kids. You can kind of talk the way adults you're used to communicating with one another. I'm going to try to move away from that, and if that doesn't tickle your fancy anymore, then go somewhere else. Okay, I'm going to try to please everybody. All right, so this left hand side chart over here, we're going to transition that to a 1 minute chart. This guy keeps stalking you. Look at him. Look at this guy, beady eyes. So it's Tuesday, February 10th, 2026. And what I'm going to cover is how we are looking for tiny little micro market structure fluctuations that are predictable. They are using the same logic. There's not a lot of moving parts to this. Okay. And what you're going to come away with today is it's not as hard as you thought it was. It's not as hard as everyone else complains about because they're trying to sell their own little widgets and little systems, their little software programs, their little this, that, and the other thing. They all want you to be disgusted with this stuff and anything else and then love them so you can pay them, so they can pay for their groceries and pay for their rental cars and all that stuff. Here, I want you to focus on just one simple concept. You have to have a higher time frame premise, something that leads to why the market should go up or down. Okay. If you can determine that, and I'm not saying you're going to learn that right away, you're going to know it every single time, you're not going to be incorrect or anything like that. You will. Okay. But something on a higher time frame chart has to give you a catalyst, something that's going to, I guess, direct your focus on expectation of the market moving higher or lower. Now, if there was a way for me to poll everyone and then all be honest, because everybody likes to inflate what they actually make, and others are just modest or maybe sometimes embarrassed or ashamed. They won't really say how much they actually work a week, get a day's wage or a week's wage or biweekly wage or a monthly wage if you're paid that way. How much money do you actually earn at your job? And because that level of misery brings with it a sense of urgency that you want to leave it so fast. You want to get out of that and make lots of money. You want to make all the money that everybody else is pretending they're making when they put their stuff on the internet. So I get it. I understand that. But I want to take you back to the basic. You can't make a lot of money. You can't get rich. You can't become super loaded real fast without any kind of opposition or any kind of hardship or without effort. So strip that away. And what I'm going to show you today is the absolute smallest on the atomic level, all that's necessary. And then you determine with your own skill set, your own personal drive or ambition, what you want to do. Your risk tolerance is paramount in this. How much can you really sit through in terms of risk? Because if you can't hold on to a trade that has six, $7,000 in risk, you're not going to be pulling down six-figure trades. You're not going to. So if you can't weather a trade that has 15 to $25,000 in risk, you're not going to take down a $500,000 trade. Not in one single pull. You're not. Okay, and that's the reality. Okay, it's not something that you want to hear because you want to hear someone blow smoke up your rear end and tickle your ears with. It's so easy. Do my thing, and you're going to get rich real quick. And that's it. But I don't do that. I want to talk to you in a manner that if you were my friend, if you were a family member, this is exactly how I talk to you. I want you to plug into common sense and then also lower your expectations on yourself. Lower the expectation that you, like everybody else does, and I've done the same thing too. We place so much emphasis on being an Olympic level performer, and it's not necessary. So while I'm talking, I'm watching the initial run here. It's now 9:30, so we're going to see what we see in price delivery. Last Wednesday, February 4th, 2026, I mentioned that these two levels here, the 25,440 even and the 25,385 level, that is the regular trading hours opening range gap for last Wednesday, February 4th. And I mentioned that when we were on that trading day, I had an eye appointment, and I wasn't able to stay with the marketplace or watching price. But I told you that I feel like they're going to want to come back up in there. Now, obviously, it's 5 days later. We're seeing it today, but it's a key level, and these levels are like new week opening gaps. They're like new day opening gaps. And I know some of you are so concerned about what happens if they go to 24-hour trading. I have other stuff I'll teach. I haven't given everything. I have lots of stuff. In fact, if it goes to 24-hour trading, it actually makes it easier. So don't have any concerns or fear about that. It's just going to make it even easier for you to do the things I'm going to show you today. But in keeping with the conversation I had started on X this morning, I posted that there is a very simple approach that leads to small steps. And that one small step that you take, if you continuously do it over and over again, it will take you to any location you want to go. It won't take you there on the time frame or duration of waiting through it to get to it, meaning it's going to take you a little bit longer than you think it should. And that's normal. Just like your children, if you have a child, you know what that feels like when you're on a long road trip. They're like, Dad, Mom, are we there yet? How much longer till we get there? Because they can't see where you're taking them. They don't have the foresight. But over time, when you get more experience in reading price action, you'll have the same perspective as you, the parent. You know where you're going. You know how far it is in terms of miles and relationship to time getting there, commuting there. But the child can't communicate that very well in terms of bridging that gap of impatience. They just want to get there because they're excited. There's no difference between that when you first start trying to trade because you think that you got to get there real quick to where? Making money. And I'm going to tell you again that that is obtainable, but you have to be realistic in the beginning and slow it down and bring it down to the smallest degree of requirements. So we're going to anchor on the fact that we had an old regular trading hours opening range gap. Okay. Now, some of you might say, well, that's not a higher time frame key level. Sure, it is. It's the open. It's the open and the previous close of regular trading hours. So how's that not higher time frame? You can't get any more higher time frame than that. You're talking about session closings and you're talking about session opens. So between the highest high and the lowest low, between those two price points, that's how we define if the regular trading hours high or low, just by delineation and identifying it. You don't even have to put any kind of labels on it. I just did it so that way you can follow the logic of what I'm talking about here. And also refer back to Wednesday when on X, I said that I feel like they're going to want to trade up in this because there's liquidity up in here. There's, there's a reason to be up in that. And we went in it today and overnight here is one of those bull flags that everybody likes to trade. Then it gave up the ghost and went lower. And then worked back up into the upper half between these two levels here. And then what does it do going into the pre-market session time? That's 7 o'clock in the morning Eastern time. Okay. So right there, now what are you going to look for? You're going to look for clean levels. Clean levels. So if we trade up into this overnight, that was last Wednesday's opening range gap on regular trading hours. In other words, it's the gap you see when um, we talk about opening range from 9:30 Eastern time when it starts trading. You would see it with ETH toggled to regular trading hours, but we're not going to do that because I have my notes on here so that way I can do this presentation inside the time frame I've allotted for. But you're looking at the difference between today's 9:30 opening price at Eastern time. That's the opening bell and stock indices. And then it'll show you the disparity between that and the previous session close at 4:14 p.m. Eastern time. That's what it's showing when you do toggles between regular trading hours and electronic trading hours. You won't see that gap. It'll just be continuous overnight trading. In the completeness without showing 5 p.m. to 6 p.m. So that little hour gap there, that's the only thing that doesn't appear in electronic trading hours. So because we're using the regular trading hours gap that I mentioned last week, I said that was the level I think that we're going to trade up into. We did that last night here, and it showed no willingness to get to the upper half. Then we entered 7 o'clock in the morning, which is a pre-market session trading. And then now what you want to do is you want to go through price action at that moment at 7 o'clock, compress everything. I hate the fact that I got to put this kind of watermark on here. It's not ego, folks. I know some of you are complaining about it, hissing and complaining because people put my stuff on their social media accounts and pretend it's them doing it or them teaching it, and or they put it on their YouTube channel. And if it's my entire lecture, I'm going to take it down by copyright. But you're welcome to do little snippets and stuff because that's like free advertising for my channel, and it's wonderful. I don't care about that. So here's relative equal lows. You see that? Now we have this one, and then we have this as well. Either one of these is a draw on liquidity. Now here's where it becomes extremely simple. This one is your buy side. Remember, this is for someone that doesn't know how to determine bias. They just want to look for something in hindsight to get lots of examples of what it looks like, collect that in their journal, annotate them, and eventually start watching it and tape reading before you even demo trade. And then once you do that for a while, and you get good at reading what it's likely to do, then you don't go into demo trading. Okay. And you only demo trade with one micro contract. You notice what I'm showing up here on the left hand side? I'm not trying to look like, Johnny Bravo out here and do 30, 50, 60, 100 lots on the minis, which is ridiculous at the moment. Okay. Because the level of volatility is so high. I'm showing you how to start appropriately with realistic expectations going in. One micro, that means you're only going to see a fluctuation of value in your equity, whether it be a demo or hypothetical, or if it's a real account. It's going to fluctuate in by the tune of $2 per point. Okay, so if you go 4 ticks, that's 1 point or one handle, that's $2. In a mini, that would have been $20. Every tick would be $5. So there's 4 ticks in a handle. 4 times 5 is 20. That's a mini. We're looking at a micro. It's the smallest contract that you can trade with the indices. By having this, it removes all of the concern for losing lots of money and building up this track record of, wow, I'm trying this stuff and I would have lost this much money in the beginning. See how it removes all that necessity about being right or wrong? It reduces it down to transactional binary. Did it work? Did it not work? Did it work? Did it not work? That's all you're trying to do in the beginning. You're collecting information and data to weather a storm of uncertainty in the beginning. And you're just focusing on the facts and the data that gives you the feedback by actually looking for these types of things. And then you have the opposing side, this. Okay, this is the level I posted on X. That was the next draw. Okay, so it happened to occur after this buy side was taken. Now let's play devil's advocate for a moment. Okay, you're going to watch this also as a draw on liquidity. Pay attention to the lecture. If this line here or relative equal highs where there was buy stops above that, or anyone that's going short here, they're going to put a protective buy stop there. Anyone that went long from here, their protective sell stop is below that. That's sell side liquidity. That's buy side liquidity. It's not imperative in the beginning for you to know which one is going to hit when we get to 7 o'clock in the morning. It's not imperative for that. If you can see two definitive levels where it could qualify, the highs to the right of the highest one here, it's lower. So that's a prime candidate. Here, same thing. These are more relatively equal, almost perfectly equal. Whichever one hits first, the opposing side is going to be traded to next. Is that hard? Is that complicated? No, absolutely not. Because the characteristic of the pre-market session is it's going to seek liquidity before the opening bell at 9:30, and then the real run of the day will ensue or unfold. Meaning, all we have to do and see at 7 o'clock which ones are going to run for next. Well, it runs to this one here. So right away, what do you think? This should act as a false breakout if this liquidity is in play. That means it's next to go or it's the next draw on liquidity. So now you look for signatures and price action to support that idea. You don't know because you're brand new, but you're waiting for information in price action to illustrate that that is in fact the highest probability going forward. So it's a session bias. So 7 o'clock in the morning to 9:30 opening in that 2.5 hour window, you're looking for hour and a half. Hour and a half. It's old age, folks. It's kicking in. So there's your run on that little liquidity pool there. You're looking for indications that it's likely to draw down here. Go back to these two purple lines. That's the regular trading hours gap, opening range gap of February 4th, 2026. When it went above that old high, it went to a gradient level. I'll let you do it on your charts. Okay, just throw your fib down, put the eighths on and quarters on, and you'll see it's trading up into that. And now it's in the upper half of it between this purple line and that purple line. And then it gives up the ghost quickly. See that? In here, we start to consolidate a little bit. And in that little area, right in here, there is inefficiencies. Now, you can't see the inefficiency I'm anchored here because it's there. See that? That's the 15-second fair value gap in a sell side imbalance, buy side inefficiency. In other words, the market's showing it wants to drop, it left an inefficiency. And now this is a chapter that I'm amplifying in the book. Okay, so in June of this year, you'll have volume one, and I have a chapter in there trading the 60-minute candlestick or 60-minute range. Okay, and by knowing what I'm showing you here, it'll help bridge the boring stuff and the things I can't adequately explain in text format or in a static picture. It doesn't communicate as effectively. So when the market's moving lower like this, we had a failed run above this high here, inefficiency there on the 1-minute chart. And then we're about to break this low and aim for that lower sell side liquidity pool. That's this one over here. That's these lows here. Okay. You're looking back over the London session for a relative equal highs and lows, by the way. So again, very, very simple stuff. I've already taught this before. It's not complicated. You don't have to have 82 PD arrays. Okay. You don't have to have every little bell and whistle. This is just simply looking for liquidity at a time of the day when the market's going to run. So you have odds in your favor that sustained price runs are going to materialize and they're going to run continuously. And you're looking for liquidity. So it's time of day, session when volatility should come in. So that's fuel. And it's going to go to power cells, okay, in the form of liquidity. These little anchor points that the market's going to gravitate to. That's the lifeblood of any market. It doesn't matter what you're trading. Without liquidity, you have no volume. Okay, so I'm ahead of the curve. All you volume guys out there, I'm already looking for something that your volume bars aren't even going to print yet. I'm looking at where the market's going to draw to. Then you're going to look at data that says how many people bought or sold at a particular level. That's all hindsight. I'm looking at where it's going to go to next. Okay. So all you need to know is where it's at now, where it came from. Well, it came from this buy side liquidity raid after 7 o'clock. It took out that buy side. It's likely to draw to where? To these relative equal lows. Now, why didn't I anchor that one here? Because I'm teaching you for simplicity's sake, isn't this an obvious relative equal low versus this low in that high, at that higher low? See, in the beginning, you're going to be fundling, fumbling around with which lows and which highs should I look at. If the market gives it to you this perfectly on a silver platter, just anchor that. That's why I picked it, because that's what a neophyte, someone brand new at this, they would see that and they would side with this versus using that low to that. And there's nothing wrong with either one of them, but I'm teaching in the mindset that, say my grandson is of age where he can now look at these things. That's who I'm talking to right now. Okay. So it's easy to see that because it's smooth versus a little bit lower and it's questionable. So if it's ever given you these types of relative equal lows and then there's a still candidate like this, just remove all ambiguity and just go right to this is all I'm going to anchor for. I'm going to reach for that. It many times will just go to this that have a deeper retracement and scare you or stop you out if you recently sold too far in a discount and then go down and take out that low at a later time. So by having the actual smoothest lows or highs utilized, it's easier for you to trust the trade. It's easier to not wrestle with, did I pick the right one or not? There's so many uncertainties that a brand new student comes into my stuff with, and they think they have to have everything perfectly oriented. And it's not going to be like that in the beginning. It's a learning curve that you have to follow and you have to submit to it. So if they've taken the buy side first, and it's inside of that larger, higher time frame opening range gap from February 4th, last Wednesday. The first time we traded up until it was here, and then we're into it here. So anyone that was lucky enough to get short here, they came right back for those guys. And it failed to get to the upper half of that, or I'm sorry, the high of it, but it went in the upper half between this purple line and that. So if you put a fib level 50% right there, it's above that, but then quickly left it. And then we get into this small little consolidation in here. So what is it going to aim for next? It could go up here and hit the low of that regular trading hours opening range gap low, that purple line. It could do that. Why didn't you expect it to do that? Watch. We have liquidity resting right here, and we have a relative equal lows here. And it quickly ran away. So buy side's been taken. Who wants to sell short to buy stops? Smart money. So if they're selling short above this high to resident buy stops, all the liquidity in the form of these highs being absorbed in here for breakout purposes or protection on shorts, it doesn't matter to smart money. They just know that the orders are resting there, and they're going to keep throwing shorts, sell orders in there to pair up as many as they can. So where would they want to get out at? If they're getting short, if smart money's now short here, where would they want to get out at? At a lower price. So where is the most advantageous levels for lower prices where people want to sell at a lower price while price is at this level here? Old lows. That's this low here. It's close proximity to this. And then you have these relative equal lows. So to remove all the doubt, you have one single low here that has a higher low to the left. That's why I did not use that one in my annotation. This one here, relative equal, almost perfectly smooth, with the second to the right being slightly higher. Look real close so you can see it's not the same thing as that one. And then this one here, the reason why I didn't annotate that is because I'm speaking in terms that someone that's brand new would probably just look at that and disregard that. Or if they didn't have it on their chart, scrolled back far enough, they just saw that and said, that's enough for me. There's nothing wrong with that, folks. There's nothing wrong with that. So inside this consolidation in here, I immediately am looking at the 15-second chart. Now, in my live session on X, I had a conversation with Kit in the community where ICT Concepts, he does a follow-up whenever I do a Twitter space or X space. He comes back with an opportunity for people that, like what we do. Um, they share their observations. If they have concerns, if they have complaints, you know, all that stuff, they get to be able to shed a little bit of personal perspective or ask me if I feel inclined to do so to amplify something. I may not do it then, but then if I don't do it then, I come back later on and I'll touch on it. It may not be in a time frame that you want me to touch and cover the conversation points that you wanted me to do, but eventually I'll get to it. Or it's something I've already talked about, and if you just keep going through the content, you'll get to it. So we're in this little area here on the 1-minute chart. This level is where the next draw is, and it doesn't look like there's anything here because it's on the 15-second chart right there. Okay, so looking at that in terms of price action, we can see that it's dropping lower, and if the market can trade up into that, we get an institutional order flow entry drill there. Make it a little bit bigger. This guy's always got his eye on me. Look at him. Sell side imbalance, buy side inefficiency, institutional order flow entry drill. As soon as it trades up into that, we want to see if we're bearish. My fair value gap, okay, it needs to show a willingness to stay open. That's the highest probability fair value gap. If you're trying to sell short, you want to see the upper half not traded to. Okay? We're not like the rest of these people out there that say, well, imbalance has always existed, blah, blah, blah. Listen to the logic I'm teaching you. If a market's weak, if it's heavy, if it doesn't want to go higher, it's not going to be concerned about closing in this one single pass. It's going to trade up into it, maybe like this. That's institutional order flow entry drill. I can tell you when they're going to happen like that. I've done it many times in trade examples where I'm recording it with a live account. Okay, just because you don't see a little bug on the screen doesn't mean it ain't real. But the point is it trades up into it, and we want to see that upper half of that be respected. Can it wick into it? Sure. We don't want to see a body left in it. And does it do it there? Yes. Trades lower. Comes right back up again. Trades just shy of getting into that inefficiency here and then breaks lower. Now, here we have a beautiful illustration of what I was talking about to Kit, where I said, let me talk a little bit about one of the chapters, which is how to trade every single hour's range. There's setups like this all day long, all day long. This is Robin's Cup winning type stuff. This is beat the guys on on blast that try to come at you. Once you learn this skill set, you can trade anything, any asset class, any time frame, and mop the floor with them. Literally, like just because you can do it doesn't obligate you to go out there and just do it because they want you to perform for them. Okay, I'm not NFL. I'm not here. I'm not here trying to entertain you. This inefficiency, the market trades up into it there perfectly. Look where the bodies stop. The wick is allowed to do that damage. Look, real close. My eyeballs got a little bit of a competition on hiding it. Order block, changing the state of delivery. Perfect. This is a 15-second chart, by the way. So if you went in there and you use this, you look for the what? Price to show a willingness to drop. It does. Volume imbalance and inefficiency that's continued to there. Small little separation between the two, but that's an inefficiency. Market trades up into this. Bang. Now what do you have? You have this low that's almost ready to get ran out. Inefficiency, inefficiency. We're trading up into here. You now can enter getting short. Second opportunity in here. Trades up into it here. That sells off. On the 5-second chart, you can see the same elements being illustrated here. So this little orange box is that little orange box shown on the 15-second chart, and it's shown now on the 5-second chart. Now, I already know some of you are like, man, ain't no way I'm looking at a 15-second to 5-second chart. You would be so much better in reading price action if you do these exercises. I'm not saying that you should trade your financial, net worth on them. I will. I do. And I teach my kids to do it. But I'm saying that you have lots of examples. How many hours are in a trading day? It's how many opportunities you have every day, every trading session, London session, Asian session, New York session, AM, lunch during the lunch hour during New York, PM session. See what I'm getting at? You have lots of canvas to work with, lots of dough to practice using your cookie cutter. Okay. So the cookie cutter is simply this: where's the market going to draw to? That's this red line right here. That's those relative equal lows that we saw on pre-session during overnight trading. 7 o'clock, we enter the time when the market's going to start seeking liquidity. It's going to have a more uniform way of running for liquidity. So it runs the buy side first. Okay, easy. Now I'm going to look for the sell side. We're in the middle of that range between high and here. So we're going to look for some kind of indication that wants to go lower. Because in this pass here or this pass here, it should have already went up into that regular trading hours opening range gap low from February 4th. It has no indication at all that it wants to get there. It's heavy. It left this quickly, and it's not going to leave a lot of time for the individuals to have their orders below here to pull their orders out. Okay, retail traders aren't spoofing. When you're looking at your depth of market type stuff and you see all these little numbers saying there's oh, look at this big buyer, look at this big seller here. Those orders may not be there waiting when price gets to it. That's spoofing. Retail traders don't do those types of things, but retail traders will want to pull their orders and close their trade before their full stop loss is taken. So anyone that's long from here and felt they dodged the bullet with this low here because it didn't trade down below their low where their stop loss would have been, they felt great here, but they didn't take out any profit. So then they've been watching it wilt lower, 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 and now we're in close proximity. That's the easiest type of setup because you're close to a level that's most likely going to get hit. I'm not requiring that a brand new student or a grandson or my kids to be in something at the highest level or back here. If it's ran here and it's likely to go down to here, as long as you have range and you can define where's the new dynamic price range, this inefficiency high to that low. See that? So in that range, we're we haven't completed it yet. And it is most likely going to trade further than where I have an interest in getting out or teaching as a brand new low hanging fruit objective to get out with. That's just below the line. You can anticipate measures of protraction beyond that, but in the beginning, don't get greedy. Just go one tick below the level you think is a sell side liquidity pool. In the beginning, being content with that, it builds. And as you get better and better at doing this and seeing it, how many opportunities it fulfills all the time. Every single day it does this, folks. Every single day, this type of phenomenon occurs every single day. But imagine all the folks that are going to be watching this that maybe they make a couple bucks here and there. Okay. They have all these other things on their chart. They don't look at anything that I teach and they think, "Ugh, this is silly. Look at this. But I promise you, I can make $1 million this year doing this, but you won't make $1 million trading what you do." Gauntlet dropped. So looking at this, we have a run lower, clear, obvious draw on liquidity, lower time frame, indicating yes, it wants to go lower, inefficiency in here, and it's going to quickly want to drop down in there. How do you know it's going to be quickly? How do you know it's going to be fast, Michael? How do you anticipate it going to be quick? So that way I can get in these like type of setouts where I don't have to sit in them long. Because in the beginning, what don't you have? Patience. That's why I'm teaching this to you today. I'm capitalizing on the fact that I already know that you're impatient. I already know that you don't know everything. I already know that you're making a big to do about things that you think you should know about or should be better have taught by me by now. This is the simple stuff I talked about in the conversations outside of the chart. That's the stuff that matters. Yeah, it's the logic. It's the thinking about the things that isn't just shown in a encapsulation of open, high, low, and close charts. What's the logic? It's going to go to liquidity. The inefficiencies, that's the other part of it. But which inefficiency, you're going to struggle with that. That's why I didn't talk about that today. The buy side and the sell side at a time when the market's going to seek it, both sides. You don't need to be right about what you think it is going to do initially. Find the counterparty. Because think about it. If the market goes up to take buy side, and we understand that smart money shorts at old highs when buy stops are taken, they use that fuel to be counterparty. They're handshaking with the open existing interest that's above old highs. When they're bearish, that's when they're trying to get in. They're adding to positions and inefficiencies between that entry point and the sell side liquidity they're aiming for, or the sell side discount inefficiency that they're aiming for. We're always using this counterparty theory. Okay. Your job is to identify a cookie cutter approach. This is the easiest one. When everything's in motion, it's going to draw down to this level here, determine how much more of a range you have. If you can get 20 handles, if it can yield 20 handles to you or 20 pips, okay, if you're trading Forex. He said it. He said, fine. He's finally talking about Forex. It doesn't matter. Either way, it works, okay? But you need to be able to determine what the pool of liquidity is it's aiming for next, okay? So by having that, we can see that even with a live account, it's the biggest 40 bucks you'll ever make when it happens in your hands the first time. Now, that same 40 bucks of entering here and then collapsing it right here, one tick below, if you did that with a mini, that's a whole lot more, isn't it? That's probably some of you in other countries, that's like a whole month's wage, 400 bucks. Think about that. What happens over time and you get more acclimated to the risk, you have more equity to allocate to each trade, you're never exposing yourself more than 1%, and technically you should be doing about 1/4 to 1/2 of 1%, and do that for the first 2 years of trading. It'll stave off a lot of the greed and a lot of the, I got it licked now, I'm going to just go hog wild and go in there and go after it all. It'll keep you from doing that. You ain't gonna have the discipline to do that. But I'm telling you, you heard it here to do that. You can grow wealth with this. You start with one micro. And then when you get $2,500 in new equity, add one more micro. When you add another 2,500 in equity, add one more micro. When you drop down 2,500, you lose one contract of leverage. You reduce it. That's a complete model now. A complete model. Having the inefficiencies here, like this, if you were entering in this, you're looking for a run up into it. Is it respecting the upper half? Yeah. It wicked outside of it here, but did it leave the body in the lower half? Yeah, outside of it. It went up into it here, left the body in the lower half. That's your telltale sign. Yes, this is a valid short. Where would your stop loss have to be if you were shorting this? Where would you want to put it? It's got to be above this candle's high. And if you're watching the market open here and it trades up and you're entering a short in this run here, your stop loss is going to look like it's going to get hit. And you've seen me do this in live executions, recorded, shown full detail, H 4K resolution and live account, and it pulls away. My stop loss game's like the best in the game. Like there isn't anybody out there that's like that. And that's the stuff I'm promising you that you will never, ever, 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 ever learn from me. I won't put it in books. I won't do it in a paid mentorship. I'm not teaching it to you. Okay. That's what separates me. I'm not going to give it to you. You can get mad at me. You can do all the campaigns and stuff, and you're a jerk. This and other thing. It's some of these things are just left for my family. Okay. And if you don't like that, I don't care. But the point is the rules that I taught still apply here. So if you're selling inside of an inefficiency, if it's a sell side and bounce buy side inefficiency, the stop has to be above the high of candle number one. If you're buying inefficiencies, you're going to enter inside the inefficiency and you're going to use the stop loss placement below candlestick number one's low. One tick, that's all you got to do. But what happens if I get stopped out? If it stops you out, for instance, if it would have came up, stopped out, broke lower, and went back up on the lower half of this, that's another re-entry. Stop loss goes straight back to candlestick number one tick plus. Is that complicated? No. Is it scary to do? Absolutely when you're brand new. Because you're still going to be arm wrestling whether you're right or wrong. See what I'm saying? So anyway, the market did in fact drop down there and then came off of that, worked inside this range here, never came back up to that there, and then dumped even lower. The sell side I mentioned while we were looking at the other stuff I was talking about here today, went below it several times, rallied back up, and we're back inside of the regular trading hours opening range gap from February 4th of last Wednesday. Okay. Look for an exploration probably to regular trading hours opening range gap high because it's unfulfilled so far. Okay. So there's existing void in here where it could want to explore that. And I have seen enough today. If I would have been trading instead of talking to you, I would have already been done. I would have taken the short in here. Let's look at that. You got to do this quickly because I'm going to run over an hour and then it won't do the translation. So bear with me if I seem like I'm rushed through this part. Any kind of questions you have about this portion, just direct it to me on X. And if I can do it in a short little snippet in response, I will. Okay. So inside this little area here, this consolidation, make sure it's showing on all time frames, all intervals. Okay. And now we can go back. Now we're into it here. This little range in here, this little line, in this range here, we don't see anything clean on the 15-second. Here, we already know that at 9:30, right there, relative equal lows, we already worked up inside regular trading hours opening range gap from last Wednesday. It started to break lower. It's probably going to want to come after that liquidity. In this little area, we don't see anything clean on the limit chart. Drop down to the 15-second chart. Do you see anything clean in there? No. Go into like if you just put the little calendar thing on the time, I can hear you. Yeah, I hear you. All right. So in here, that's not entry right there. That would have been it. That close, we open, trade down. The next candle we open right there. This is immediate rebalance. This is the entry technique I would have used for that. I know some of you are like, oh, it's easy to say after the fact. If you went through my mentorship, you know about what an immediate rebalance is. Opens here, comes right back up, closes the gap immediately in one pass, bang. If it can do this, and I've said this before, and there's lectures on my YouTube channel here where I talk about immediate rebalance. When this occurs, it's the strongest indication that that candle that immediately fills it, like it does here, it either wilts and goes directly in the direction that you think it's going to go, or it's the very next candle. It's immediate feedback. Immediate feedback. Next candle opens, bottom falls out, trades down. So it doesn't matter really if we understand that there's a lot of parts that I can make available to you for trading, entry techniques, concepts, stop loss management, whatnot. The idea of simplifying it, looking for runs that are not yet complete and looking for small little gaps and waiting for them to trade up into them that will put you in the direction of that incomplete run that's likely to continue and deliver, which in this case was a sell side delivery. I think that's going to be it. There's your ending to regular trading hours opening range gap high. So that right there in and of itself is a small little micro scalp. And I got lucky there too, by the way. So I've used up all my luck for today. I'm going to wish you all a pleasant day. And I'll follow up later on this afternoon with the YouTube video review on whatever the complete day does. Until I talk to you next time, be safe.